Welcome back, dear students and scholars. I hope you are doing well. In video 1, we built the foundation for ASC 275: scope, exclusions, the disclosure filter, near term severe impact, and the 4 disclosure areas. Now we apply that knowledge. This session is about judgment. We will use a mini case, 4 multiple choice questions, 2 short answer questions, and a final memory map to see how risks and uncertainties move from facts to disclosure decisions under US GAAP. Use the decision path on this slide as your exam routine. First, identify the risk or uncertainty. Second, classify the area, nature of operations, estimates, significant estimates, or concentrations. Third, check near term, which means not more than 1 year from the financial statement date. Fourth, apply the correct threshold. For significant estimates, think material effect on reported amounts. For concentrations, think severe impact on normal functioning. Then decide whether disclosure is required. Sensitive estimates matter because financial statements often include amounts that are based on judgment rather than certainty. Inventory may lose value as products age. Deferred tax valuation allowances depend on future taxable income. Capitalized software costs depend on recoverability. Loan allowances depend on credit quality. Environmental and litigation obligations can change as facts develop. The disclosure question is not whether an estimate exists. The question is whether a reasonably possible near term change could materially affect reported amounts. Concentration risk is about dependency. A company may depend heavily on one customer, one supplier, one market, one critical input, or operations in one foreign location. That dependency can create vulnerability even when current performance looks strong. Under ASC 275, concentration disclosure focuses on reasonably possible disruption and severe impact. For major customers, remember the special assumption: loss of the customer is treated as reasonably possible, even if management believes the relationship is currently stable. Now apply the facts for NovaChip Systems. This fictional company earns 70% of revenue from one customer. It holds $42 million of specialized inventory tied to current generation chip architecture. A competing chip is expected to reach the market within 9 months. The question is not, is this company doomed? The better question is, which ASC 275 disclosure areas should management evaluate and what threshold applies to each issue? The case creates 2 separate disclosure issues. First, the customer relationship is a concentration. Because 70% of revenue depends on one customer and loss of a customer is considered reasonably possible, management evaluates severe impact. Losing that customer would likely disrupt normal operations, so concentration disclosure is required. Second, the inventory valuation is a significant estimate issue. Competing technology within 9 months creates near term uncertainty, and a write down of specialized inventory could materially affect reported amounts. That supports significant estimate disclosure. ASC 275 often works beside other codification topics. Inventory issues may also involve ASC 330. Long lived asset issues may involve ASC 360. Environmental obligations may involve ASC 410. Litigation contingencies may involve ASC 450. Guarantees may involve ASC 460, and deferred tax valuation allowances may involve ASC 740. The key idea is that ASC 275 supplements those topics. It does not replace their recognition, measurement, or disclosure requirements. For MCQ 1, focus on the 4 ASC 275 disclosure areas. The question asks which item belongs inside the standard. Do not select an answer only because it sounds like a business risk. Internal controls, proposed accounting changes, and management succession are familiar topics, but they are outside ASC 275. Identify the option that is actually part of the disclosure framework. The correct answer is B, nature of operations. That is one of the 4 ASC 275 disclosure areas. Option A is wrong because internal control deficiencies are governed by other reporting and attestation frameworks. Option C is wrong because proposed accounting changes are addressed outside this topic, including accounting change guidance. Option D is wrong because management succession risk is a personnel and governance matter, not an ASC 275 disclosure area. For MCQ2, the key term is near term. This is a precise definition, not a flexible management estimate. The near term window is not 5 years, not only the next quarter, and not whatever period management prefers. Think of the financial statement date as the starting point, then apply the standard's 1 year limit. The correct answer is A, not more than 1 year from the financial statement date. Option B is wrong because 5 years is too broad for ASC 275. Option C is wrong because 1 quarter is too narrow. Option D is wrong because management cannot redefine the near term window. The 1 year rule creates a disciplined and comparable disclosure threshold. For MCQ3, focus on severe impact. This is higher than ordinary materiality, but it does not require bankruptcy. The standard is looking for a significant financial disruption to the entity's normal functioning. So avoid two extreme mistakes: treating every small disruption as severe or waiting until the entity is near collapse. The correct answer is C, significant financial disruption to normal functioning. Option A is wrong because immaterial disruption is far below the threshold. Option B is wrong because severe impact is higher than ordinary materiality. Option D is wrong because bankruptcy is not required. A severe impact can be serious enough to disrupt operations while still falling short of a catastrophic outcome. For MCQ 4, apply the concentration disclosure test. The issue is whether loss or disruption is reasonably possible and whether the effect would be severe. In customer concentration cases, ASC 275 assumes that a major customer could be lost. The analysis then turns to the magnitude of the impact on the entity. The correct answer is B. Loss is reasonably possible and the impact would be severe. Option A is wrong because the standard deals with uncertainty, not a conclusion that loss is impossible. Option C is wrong because ASC 275 focuses on existing risks and uncertainties with near term consequences, not resolved past events with no future effect. Option D is wrong because management's personal opinion about a customer or supplier is irrelevant. The test is objective and standards based. For short answer practice 1, build the response around the 4 disclosure areas. Nature of operations explains what the entity does and where it operates. Use of estimates tells users that GAAP financial statements rely on management judgment. Certain significant estimates covers estimates where a reasonably possible near-term change could materially affect reported amounts. Certain concentrations covers dependencies where reasonably possible disruption could severely affect the entity. For short answer practice 2, use a two-gate structure. Gate 1. It is reasonably possible that the estimate will change within 1 year of the financial statement date. Gate 2. The change would have a material effect on reported financial statement amounts. Then add what the disclosure should include: the nature of the uncertainty, why the estimate is sensitive, and the range of reasonably possible outcomes if that range can be estimated. Do not use severe impact as the significant estimate threshold. Severe impact belongs to concentrations. Before we close ASC 275, lock these 6 anchors into memory. Scope: full US GAAP financial statements. Filter: disclose useful forward-looking risks, not every possible risk. Areas: operations, estimates, significant estimates, and concentrations. Near term: not more than 1 year from the financial statement date. Severe impact: the concentration threshold, higher than material and less than catastrophic. Links: ASC 275 supplements other topics such as inventory, long lived assets, environmental obligations, contingencies, guarantees, and income taxes. Next, we move to ASC 280, segment reporting. Please like this video, share it with your colleagues, subscribe to Commerce Regiment, and support the channel so we can keep building premium US GAAP education.